If you turned 65 in the last few years and nobody told you about the $6,000 the IRS will let you deduct this year, you could be about to overpay your taxes by hundreds, maybe thousands of dollars without ever knowing it happened. There's a new deduction sitting on the table right now that most tax software will only catch if you check one small box correctly. And there are 7 other rules just like it. Changes to Social Security, Medicare, and your retirement accounts that most retirees have never heard explained in plain English. And heads up, this is general information, not personal tax advice. So keep your own numbers in mind as we go. Now here's rule number 1, because this one alone could be worth thousands of dollars to you this year. Let's start with why this matters so much right now. If you're 65 or older or getting close to it, the tax rules that applied to you 5 years ago are not the same rules that apply to you today. Congress passed a major tax law in the summer of 2025. The Social Security Administration made a historic change to how certain pensions get taxed at the start of that same year. And the IRS has been quietly updating dollar thresholds for things like Medicare premiums and charitable giving almost every single year. Most people find out about these changes by accident, usually from a neighbor. Or worse, they find out in April when their tax preparer mentions something they should have done back in January. A lot of retirees are still filing their taxes the exact same way they did in 2015, using the same mental checklist, assuming the rules haven't moved. But they have moved in ways that could put real money either into your pocket or straight into the IRS's, depending on whether you know about them. Here's where these numbers come from, so you know this isn't guesswork. The $6,000 deduction we're about to cover is written directly into what's officially called the One Big Beautiful Bill Act, signed into law in July of 2025, and the IRS confirmed the exact rules for it in its own 2026 filing season guidance for seniors. The Social Security changes come from the Social Security Fairness Act, which became law in January of 2025. The required minimum distribution ages come from the Secure 2.0 Act, and the Medicare premium numbers come straight from the Centers for Medicare and Medicaid Services 2026 premium announcement. None of this is speculation. It's already the law, or it's already been officially announced. The only question is whether you're using it. And here's why the quiet part matters so much. Unlike a new stimulus check or a headline tax cut, none of these 10 things arrive in the mail with a big announcement. The IRS doesn't call you. Your bank doesn't send a letter explaining that your Social Security combined income threshold hasn't moved since Ronald Reagan was president. Your tax software might apply some of these correctly and completely miss others, depending on how carefully you answer the interview questions. That's the gap this video is built to close. One rule at a time, so you're not the person who finds out about a $6,000 deduction 2 tax seasons after everyone else already claimed it. Let's get into it. Number 1 is the new senior bonus deduction, and this is the big one. Starting with your 2025 tax return, the one you file in early 2026, if you turned 65 on or before December 31st of the tax year, you can claim an additional $6,000 deduction on top of everything else you already qualify for. If you're married and both you and your spouse are 65 or older, that's $12,000 off your taxable income combined. Here's the part most people miss. This deduction applies whether you take the standard deduction or you itemize, which is unusual because most senior tax breaks only apply if you're taking the standard deduction. There is an income limit though. It starts phasing out once your modified adjusted gross income passes $75,000 for a single filer or $150,000 for a married couple filing jointly, and it disappears completely above $175,000 single or $250,000 joint. So picture a 68-year-old widow with $60,000 in retirement income. She qualifies for the full $6,000, no phase out at all. That's real money coming off her taxable income this year and for tax years 2025 through 2028, because right now this deduction is temporary. It's scheduled to expire after 2028 unless Congress extends it. Now compare that widow to a retired couple with $165,000 in combined pension and investment income. They're above the $150,000 joint threshold, so their $12,000 combined deduction starts shrinking, reduced by 6 cents for every dollar over the limit until it phases out entirely at $250,000. Here's what most people get wrong about this deduction. It's calculated automatically by tax software based on the birth date you enter. But if you're filing a paper return, you have to manually check the born before January 2nd, 1961 box yourself. And if you skip it, the IRS has no way of knowing you qualify. Nobody flags that for you. It's also worth remembering this deduction is temporary. It applies to tax years 2025 through 2028 only, so this is a 4-year window, not not a permanent fixture of the tax code. Most people stop here. They see new deduction and move on. But don't, because this one stacks on top of something you may already qualify for. Number 2 is the older separate extra standard deduction that's existed for years. And a lot of retirees don't realize it's a completely different benefit from the new $6,000 bonus. If you're 65 or older and you take the standard deduction, you already get an extra amount added on top of the regular standard deduction. And for 2026, that extra amount is $2,050 if you're single or $1,650 per qualifying spouse if you're married filing jointly. If you're 65 and also blind, you get double that amount. Here's the part that trips people up. This is stacked on top of the regular standard deduction. And then the new $6,000 bonus deduction stacks on top of that. So a single 68-year-old taking the standard deduction in 2026 could be looking at something like $16,100 as the base standard deduction, plus $2,050 for being over 65, plus $6,000 for the new bonus, which adds up to roughly $24,150 in total deductions before you've claimed a single itemized expense. Most retirees have no idea these three numbers stack together, and tax software doesn't always explain it clearly. It just spits out a final number. Here's the part they never tell you. If your date of birth isn't entered correctly, or if you're using an old worksheet from a few years ago, you can accidentally leave one of these pieces off entirely. Now here's where it gets important, because number 3 is the one that costs people the most money every single year, and it hasn't changed in decades, which is exactly the problem. It's how much of your Social Security benefit actually gets taxed. Here's the part almost nobody explains clearly. The IRS uses something called combined income, which is your adjusted gross income plus any tax-exempt interest you earned, plus half of your Social Security benefit for the year. If that combined income is between $25,000 and $34,000 for a single filer, up to 50% of your Social Security can become taxable. Cross above $34,000 and up to 85% of your benefit can be taxed. For a married couple filing jointly, those numbers are $32,000 and $44,000. Here's why this matters so much right now. Those thresholds were set back in the 1980s and 1990s, and they have never been adjusted for inflation, not once. Meanwhile, Social Security payments themselves get a cost of living increase almost every year. So every year, more and more retirees get pushed over these thresholds simply because their benefit check went up, even though the actual value of that money hasn't changed at all. Picture a 72-year-old with a modest pension and Social Security who took an extra $8,000 out of a traditional IRA for a home repair. That single withdrawal alone can be enough to push 85% of his Social Security into taxable territory for the entire year, not just the withdrawal. Now compare that to a 66-year-old couple living mostly on $38,000 a year in Social Security and a small pension. Their combined income comfortably sits below $32,000, so none of their Social Security is taxed at all. Same government program, same age range, wildly different outcome entirely because of one number. How much other income landed on top of the Social Security check that year? This is exactly why so many retirees get an unpleasant surprise the year they sell a piece of property, take a larger IRA withdrawal for a home repair, or start a small pension they'd forgotten they were owed. Most retirees never run this math before pulling extra money out of a retirement account, and it's the single most common surprise on a retiree's tax return. Number 4 is the Social Security Fairness Act. And if you or your spouse ever worked as a teacher, firefighter, police officer, postal worker, or in another job with a government pension that didn't pay into Social Security, this one is worth checking immediately. For decades, 2 rules called the windfall elimination provision and the government pension offset reduced or completely eliminated Social Security benefits for people in that exact situation, even if they'd also worked enough years in Social Security covered jobs to qualify. In January of 2025, Congress passed the Social Security Fairness Act, which repealed both of those provisions entirely. If this affects you, the Social Security Administration has been sending out retroactive payments and adjusting monthly benefits going forward. Here's what most people in this group don't realize. Some of that retroactive lump sum may be taxable in the year you actually received it, not spread out over the years it was originally owed. And that can bump you into a higher combined income bracket for Social Security taxation, the exact rule we just covered in number 3. If you or your spouse had a government pension and never checked whether this law affected you, that's tens of thousands of dollars in some cases that you may not even know you're entitled to. Here's the part they never tell you about number 5, and it's about your retirement accounts specifically. The age at which you're required to start pulling money out of a traditional IRA or 401k, known as your required minimum distribution age, changed under a law called Secure 2.0. If you were born between 1951 and 1959, your RMDs start at age 73. If you were born in 1960 or later, they don't start until age 75. This matters because a lot of retirees are still working off the old rule, which used to be age 70 and a half, and some are still using outdated worksheets or advice from a financial article written years ago. If you take your first RMD too early because you're going off old information, you're paying tax on money you weren't actually required to withdraw yet. On the flip side, if you miss your RMD once you're actually required to take it, the penalty is steep, 25% of the amount you should have withdrawn, though it drops to 10% if you correct the mistake within 2 years. Most people stop here and just remember one number, but don't, because your actual RMD age depends entirely on your birth year, not some general rule you heard once. Number 6 is a strategy most retirees have literally never heard of, called a Qualified Charitable Distribution, or QCD. And if you give the charity at all, even modestly, this could change how you do it forever. Once you're 70 and a half, you can transfer money directly from a traditional IRA to a qualified charity up to $111,000 per person for 2026. And here's the key part. That money never counts as income on your tax return. It's not a deduction you claim. It simply never shows up as taxable in the first place. If you're already required to take an RMD, a QCD can satisfy some or all of that requirement without adding a single dollar to your taxable income. Compare that to writing a check to your church or a charity from your bank account. If you're one of the roughly 90% of retirees who take the standard deduction instead of itemizing, that check gets you zero tax benefit. None. A QCD gets you the full benefit every single time because it lowers your income before any of the other calculations happen, including the Social Security taxation rules from number 3 and the Medicare premium rules we're about to cover in number 7. Picture a 74-year-old who normally writes a $6,000 check to his synagogue every year and takes the standard deduction. If he instead has his IRA custodian send that $6,000 directly to the synagogue as a QCD, he keeps his full standard deduction and removes $6,000 from his taxable income at the same time. Same gift, same charity, but one version saves him real money and the other saves him nothing. Now stretch that out. A 76-year-old with a $40,000 RMD who routes $15,000 of it to her church and 2 other charities as QCDs only reports $25,000 of that RMD as taxable income, even though her full RMD requirement is satisfied. Over 10 years of retirement, giving that same $15,000 a year, that's $150,000 that never touched her tax return at all. And depending on her bracket, that can mean tens of thousands of dollars kept out of the IRS's hands over the course of her retirement. Money that either stays in her pocket or goes further to the causes she already cared about. Now here's where it gets important because number 7 is about your Medicare premium. And this is one where a single extra dollar of income can genuinely cost you real money. It's called IRMAA, which stands for Income Related Monthly Adjustment Amount. And it's a surcharge added to your Medicare Part B and Part D premiums if your income is above certain thresholds. For 2026, if your modified adjusted gross income from 2 years earlier, meaning your 2024 tax return, was above $109,000 as a single filer or $218,000 for a married couple, you start paying a higher Medicare premium. And it goes up in tiers from there. Here's the part that catches people off guard. It's not a gradual increase. It's a cliff. Go even $1 over a threshold, and you can be bumped into paying an extra several $100s a year in Medicare premiums, sometimes more for that entire year. This is exactly why a big one-time withdrawal, a Roth conversion, or even a large required minimum distribution in a single year can quietly cost you far more than just the income tax on it, because it can also trigger a higher Medicare bill 2 years later. Most retirees never connect these two things. They think about their tax bracket, but they don't think about the Medicare bracket sitting right behind it. Picture a 74-year-old whose modified adjusted gross income was normally around $104,000, comfortably under the $109,000 threshold. He does a $10,000 Roth conversion in 1 year to simplify his future taxes, which pushes his income to $114,000. 2 years later, when that tax return is used to calculate his Medicare premium, he and his wife both get bumped into a higher IRMAA tier, adding roughly $1,000 a year in extra premiums for the both of them for that single year, over a conversion that saved him far less than that in income tax. That's not a reason to avoid Roth conversions entirely. It's a reason to check the IRMAA thresholds first, every single time, before you decide how much to convert. Number 8, and this one's for anyone still working part-time or with earned income after 55. If you're 50 or older, you're allowed to contribute more to a 401k than younger workers through what's called a catch-up contribution. And for 2026, that limit is $32,500 total, including the catch-up. But here's what almost nobody knows. If you're specifically between the ages of 60 and 63, there's an even higher super catch-up limit, letting you contribute up to $35,750 in 2026. That's a window of exactly 4 years where the rules are more generous than at any other age, before or after. If you're in your early 60s, still working, and haven't checked whether your employer plan allows this, that's a gap worth closing before that window closes on your 64th birthday. Number 9 is about withholding, and this one causes more panic every April than almost anything else on this list. When you take money out of a traditional IRA or 401k for a required minimum distribution, the default withholding rate your custodian applies is usually just 10%. For a lot of retirees whose actual tax bracket, once you add up the RMD, a pension, and part of their Social Security, ends up closer to 22% or 24%, that 10% withholding isn't nearly enough, and they end up owing a surprise balance at tax time, sometimes with an underpayment penalty added on top. Here's what most people don't know. You're allowed to request any withholding percentage you want directly from your IRA custodian, including 100% if you want your entire year's tax bill covered by a single December distribution. A 71-year-old with a $30,000 RMD who requests 22% withholding instead of the default 10% has already covered nearly $3,600 more of his tax bill before April even arrives, with zero extra paperwork beyond one form to his custodian. Number 10 is about what happens to a surviving spouse, and this is one nobody wants to think about, but it's exactly why it belongs on this list. When one spouse passes away, the survivor's tax filing status typically changes from married filing jointly to single, starting the very next tax year. Here's the part that catches people off guard. The household's income often doesn't drop by much. Maybe one Social Security check goes away, but the standard deduction is roughly cut in half. And every one of the thresholds we've talked about tonight, the Social Security taxation brackets, the IRMAA cliffs, the tax brackets themselves, all shrink to the single filer amounts. A surviving 78-year-old widow who previously paid no IRMAA surcharge at all as part of a couple with $150,000 in combined income can suddenly find herself well above the single filer threshold of $109,000, even though her income barely changed, and her Medicare premium can jump by well over $1,000 a year almost overnight. Couples in their late 60s and 70s who run this scenario ahead of time, often through a Roth conversion while both spouses are alive, can soften that blow years before it ever happens. Here's the part they never tell you about all 10 of these rules together. Several of them work as a team. That new $6,000 senior bonus deduction from number 1 doesn't just lower your regular tax bill, it can also offset the tax owed on a Roth conversion, meaning some retirees are using this temporary 4-year deduction window to convert a chunk of their traditional IRA to a Roth IRA essentially tax-free, while the deduction is available. Since Roth IRAs don't have required minimum distributions during your lifetime, that conversion can reduce your future RMDs, which reduces your future Social Security taxation exposure from number 3, which reduces your future Medicare premium risk from number 7. One deduction, 3 downstream benefits, and almost nobody puts these pieces together on their own. So here's your one action step for this week, and it's simple. Pull up your most recent tax return, or if you haven't filed yet this year, pull up last year's, and check one specific line, your total combined income for Social Security taxation purposes, meaning your adjusted gross income plus half your Social Security benefit. Compare that number to the $25,000 and $34,000 thresholds if you're single, or $32,000 and $44,000 if you're married filing jointly. If you're within a few $1,000s of one of those lines, that's your signal to look into a Qualified Charitable Distribution or the new $6,000 senior deduction before you take any additional withdrawals this year, not after. You can find the current QCD rules directly on irs.gov by searching Publication 590-B. And the senior deduction details are in the IRS's own 2026 filing season page for seniors. 15 minutes with your actual numbers done today is worth more than any general advice, including this video. If this helped you understand something about your own taxes that you didn't know before today, that's exactly why this channel exists. To break down exactly what's changing with your Social Security, your Medicare, and your retirement accounts in plain English before it costs you money. Subscribe if you want more of this, and next week we're going deeper into exactly how Roth conversions interact with Medicare's IRMAA cliffs, because that's the one combination that catches even careful retirees off guard.